Hi everybody, this is Hub and Giacomo, and today I'm with Ayesha Tariq. She is the founder of Macrovisor, and she's a CFA chartered. And today we're going to talk about the Fed policy, how the Fed and the U.S. economy could go from now on, and we'll also talk about some of the international struggles that we are witnessing, more specifically in the oil market. So Ayesha, please introduce yourself, and then we'll start with the questions.
Well, first of all, thank you so much for having me. I'm honored to be on your show. So basically, you already introduced me a little bit, but let me just give you a brief background. So I've been a banker for most of my life, corporate banker. And then once I left banking, I started doing asset management. So I was heading the treasury function for a large family group over here. And we managed assets of about $1 billion. And that included real estate, hospitality, and listed equities. So from there, I got more into, listed equities, because when you're a banker, when you're a corporate banker, you can't really trade. It's very difficult because you have a lot of inside information. So from there, I started trading. And then during COVID, obviously, things were a bit down. I started my own consultancy, doing deals, raising capital for companies. But during COVID, obviously, a lot of businesses, were at a standstill. And so I started getting more involved with Twitter. And there I met my partners. And then we started a company. And that's how Macrovisor was born. We're about 1 year old now. And what we look at is the global macro environment. So we look at, everything that's affecting the global macro. And from there, we look at different strategies that we can use for investing. And that could be investing in countries, in currencies, in different asset classes like commodities, or even stocks. Obviously, stocks are the most popular, and that's where we concentrate most of our ideas.
Okay. So for the content of today, I wanted to start off by talking about what's going on in the US. So everybody is focused on the Federal Reserve. What can we expect going forward? What are the cuts that we could expect? How many of them can we expect? And if anything different happens, how could that affect the market?
Sure. So we had a very interesting meeting in January. So the Fed meeting was basically not what a lot of people probably expected. They did sort of confirm that they were not ready to cut in March, but they were also very optimistic about the inflation data and, the economy in general. So from what it seems, the Fed is sort of seeing this as a win for them. So everything that they have done has actually helped and has affected, the inflation. So he used some very interesting wording during the meeting, where everybody is looking for, the inflation number to go down to 2%. And yes, that is still the target, obviously. But what he said was we need more good data. Okay, so he didn't say we need better data, but we need more good data, right? So, and that sort of signifies that they are quite comfortable with the way inflation is moving right now, which means that we're likely to see them take some time before they start cutting rates. So he said we've already had 6 months of good data, and we're looking for another 6 months of good data. So 12 months of good data. And that sort of takes us to May, June, let's say. And this is why we think that, the Fed will probably start cutting in May, maybe is a little early even. We think it might be more towards June, July, because the situation right now is such that they don't really need to cut rates. Inflation is going as it is, growth is stable. And one of the biggest reasons that the Fed starts cutting rates is when unemployment starts to go up very much, right? But what we've seen in the US is unemployment is actually at historic lows. So there is no immediate reason for him to cut rates, or for them to cut rates, sorry. You don't have a recession. Actually, you have above normal growth, and you don't have a high level of unemployment. So they can go on like this and watch the data to see inflation come down for a while. And then perhaps in June, July, they think about cutting rates, because after that point, we might see some pressure on growth. We might see some pressure on, um, actually maybe more pressure on the corporates and small businesses because of keeping rates high for too long, right? And we're already seeing some issues with commercial real estate. And perhaps to avoid those kind of situations, they may start cutting rates before anything starts to sort of break in the system. So all in all, I think it's a very optimistic environment. And if the Fed starts cutting, they would do so like insurance cuts. So they're doing it so to make sure that there isn't a recession after that, or at least a deep, deep decline or a very high level of unemployment.
Okay, okay. And another thing that I wanted to mention, given the fact that the job market is doing very well, what is the effect of the change in industrial policy made by the US, namely, for example, the Inflation Reduction Act? Is it something that is really changing? Because it's a policy, it's a kind of policy that we haven't seen from the US in a long time. Is it really changing something? Is the US going to be a manufacturing hub from now on?
So I think when you say manufacturing hub, they already have some manufacturing, but when you say a hub, I think that's still a long way off, right? Because at the end of the day, we all know one thing. It is more expensive to manufacture in the US compared to various other countries, right? One of the biggest reasons that manufacturing and all these production move to places like China, Vietnam, India, Bangladesh, Pakistan is because it was more expensive to do that kind of manufacturing in, the US and Europe. So there's a distinction here. So there will be certain industries and certain sectors where they are promoting the manufacturing sector. So for example, semiconductors, green energy, and a few others, let's say thematic sectors. But when you say in general manufacturing, I don't think it's going to be widespread, right? So we still have that distinction between US and the rest of the world. Now, in those terms, a lot of the spillover is going towards Mexico. So we've recently seen Mexico has picked up a lot in terms of manufacturing and production. And in fact, for the first time in, I think, maybe I want to say 10, 12 years, Mexico has become the largest exporting partner to the US, taking over China.
Okay.
So, these things make a big difference, right? So it's not just the US, but some of the spillover is going over to countries that are surrounding the US. So in those terms, yes, to answer your question, yes, there are certain sectors where job creation is happening, where manufacturing is improving because of the fiscal policies, but it's not uniform across all sectors.
Okay. And another thing that I wanted to mention, the importance that oil has and the effect that it has on inflation, for example, what can we expect in the oil market? More specifically, what do you think OPEC is going to do in going forward? Because from our understanding, it's always hard to understand what is the policy that OPEC has and how it is affected by the crisis, for example, in the Red Sea.
Sure. So let's talk about the Red Sea first, right? So I'll give you some numbers as to what's happening. So first of all, we know that it's the Suez Canal and the Red Sea, which is mainly blocked. And this is the Bab el-Mandeb Strait, right? Now, this is towards the west of Saudi Arabia. Now, that channel basically, if you look at 2023 numbers, there was about 7 million barrels per day of oil flowing through that channel. Okay. Whereas on this side of Saudi Arabia, which is the eastern side, towards Dubai, where I live, that strait, which is called the Strait of Hormuz, that's where about 21 million barrels of oil per day passed through that strait, right? So it's almost 3 times what we're seeing for the Red Sea in normal conditions. However, we are seeing some pressure from Red Sea issues, right? So since December, I want to say mid-December, when all of this started to, really pick up, we've seen about a 50% reduction in, oil flows through the Red Sea. So now we're about 3 million barrels per day, 3.2 million barrels per day through the Red Sea. But this is mostly affecting Europe because this is the direct channel towards Europe, right? So, heating oil and then, crude oil towards Europe to be refined, and those Russian oil coming out of Europe. So that's basically what's being hampered. So regular oil flows, which flows to the rest of the world, I want to say China, India, the big consumers on that side of the world, that's, let's say, kind of unaffected, right?
Okay.
So that's one side of the issue. The other side of the issue is you were asking about OPEC. Now, for OPEC, they need oil to remain at a certain level, okay? And this needs to be at least now $80 per barrel on Brent, right? So which is the European oil. And the reason is because they do their budgets in a certain way, which is linked to oil prices, because all these are oil-producing countries, right? So for Saudi now, because Saudi Arabia has a lot of, new policies, they're building this big city in towards the Red Sea, and they have all these initiatives, right? So they have a lot of spending coming up. And in order to cover this spending, they need to make sure that they are earning enough from, oil revenues to be able to support that spending. So what they've done is they have, put production limits or output limits for certain countries. Now, this obviously, when supply is down, your prices go up. And so one of the reasons that, we're seeing the oil prices be unstable is because different countries are behaving differently towards these output limits, okay? Um, Saudi Arabia, OPEC actually is supposed to decide on whether they want to change these limits or not in early March when the OPEC meeting happens. But yesterday, the Saudi minister came out and said, we might change our limits whenever we want. Okay. And he said this so that there's always this little pressure on the oil prices, right? He never wants to take his foot off the gas,
Yeah.
forgive the pun. So, they're always trying to manage those limits to make sure that, there's never a situation where oil suddenly falls to like $50 a barrel or $40 a barrel. And so what we think is in March, they will keep the highest cuts in place, which is 2.2 million barrels per day. And then maybe towards like Q3 or Q4, they will start to, reduce these cuts, right? So more oil production will come through. And that will make sense because if you look at how, manufacturing and industrial production is improving across the world, by the end of the year, we're likely to see more demand for oil. So even if they start to release more oil into the market, because there will be higher demand, we might see prices still remain above 75 or towards $80 per barrel.
Okay, okay. And given the outlook that you have talked about, the most stressed region looks like it's going to be Europe. Do you think Europe, for example, the ECB is going to follow the Fed in policy, or is it going to change due to the rise that could happen in the energy products like oil, gas, and so on?
So interestingly, yes, we are seeing some pressure in, the European oil levels, but also at the same time, there seems to be, periods of warmer weather in Europe, right? And so even demand is coming down a little bit over there. Plus, Europe is more, reliant on natural gas. So, and the natural gas flows have been kind of okay. they've also built up stock of natural gas. So if you look at the inflation numbers in Europe, they're actually falling faster than US. And so, you know, our view is that Europe might actually end up, or the ECB might actually end up cutting before the Fed starts cutting, which will be unusual because everybody says that they always follow the Fed. But if you look at their last few meetings and the way President Lagarde has been talking, right? She's been very firm in her own views and not sort of following the Fed. So December was a very interesting meeting where the Fed came out and they were very, very dovish, and they were not at all talking about, cuts or anything like that. And President Lagarde, she came on like 2 days later, no, one day later. In fact, it was Wednesday and Thursday, and she came on one day later, and she was super hawkish. And, she was like, she had her own views and her own policies, not following the Fed. Now, with the way we're seeing growth slow down in Europe, especially in Germany, which is obviously one of the biggest economies. I mean, Italy is doing really well, by the way, so which is like a big contrast. But because Germany and France is also okay, but this kind of slowdown and the manufacturing and the industrial production numbers, we might actually see the ECB think about cutting before the Fed. And yesterday I was reading there's been a lot of ECB speakers who are coming out and sort of making the way for for ECB cuts. Like they started talking like, oh, we might need to cut sooner, or the time for easing is coming. So let's see. It's anyone's guess.
Okay. So I wanted to ask one last question. You talked about Germany. Is Germany in struggle just because of the change in supply of gas, given the fact that they don't have Nord Stream 2 anymore, and their they mainly rely, I think, on Norway, or
Yes.
is it something else that it's not working for Germany right now?
So I think with Germany, there's been like look, I'm not an expert on Germany. Okay,
Okay.
let me put it there. But I think from everything that I read, and we write about, when we write about, we usually write about the euro area. But obviously Germany is the biggest economy, and so we do keep track of that a little bit. But I think what's happening with Germany is a couple of things, okay? So right now, so manufacturing was really hit. And all of this started from the time of the supply chain crisis, right? So when there was a supply chain crisis, a lot of the manufacturing had to like slow down big time. And so a lot of that started. Then we had energy crisis, and then we had, so it's just one thing after another, and that's sort of slowing down the economy to a level, and then inflation. And now we have a situation where people and unions and employees and workers are asking for more and more um, salaries and wages, right?
Okay.
So now this is putting a different kind of pressure on companies, because are you going to pay for your, goods, or are you going to pay for your people? So every increase in wages obviously puts a lot of pressure on companies. During the energy crisis, a lot of manufacturing facilities actually shut down completely. And with these kind of facilities, what can happen is once they shut down, to start up again, it takes a long time. So again, you have a situation where people are out of work as well, right? And inflation is high. And so they need to survive. And so it's become it's just a difficult situation there because of several factors that came in, one after the other over the last 2 to 3 years.
Okay. So I'm done with the question, Aisha. Thank you for coming on the channel. Thank you for taking the time. And yeah, if you want to add anything else, feel free to do so. If not, I really want to thank you for being here.
Thank you so much. That was a great conversation. Thank you for having me.
Okay. So this is it for today. I'm Giacomo. This is Hustle Hub. See you next time.